I wanted to talk to that person who's looking to make that financial leap, maybe to go ahead and buy their first home. Maybe you have a home and you want to go ahead and refinance. Possibly, maybe you're that person who's looking to expand your business. You're looking for a business line of credit. You're looking to open up a business or maybe even switch jobs. I'm going to show you guys how to prepare when you get to that point right now. So if this is the first time tuning in, again, this is my J Lobo's channel. So consider liking, subscribing, and commenting. And obviously, if it's something that's very interesting and you could benefit from it and you could share this with other people as well, do that as well. Because in this channel, I talk to you guys about financial topics such as mortgages, business loans, and obviously credit or credit repair, right? So getting back into our topic, how do we prepare ourselves or how do we know if we're actually ready to make those financial commitments, those next steps when actually purchasing a home? What is it exactly that underwriters are looking for, right? And I really wanted to go ahead and not only share from my own personal experience, but I also wanted to give you guys also a little bit of background on myself. So as you guys might know or not know, especially the new ones to this channel, a little bit of background. I'm obviously the owner of Buildworth Strategies. We're a credit repair organization here located in Miami, Florida. I've had this business now a little bit over 5 years. Prior to this, I was actually a business banker for Bank of America for 6 years as well in Doral, Florida, obviously in Miami as well. And prior to that, I also have extensive knowledge when it comes actually to mortgages, since I was a mortgage broker as well here in Miami, Florida, right? So jumping into the topic, so how do we prepare ourselves, or how do we know if we're actually ready to make this huge commitment, right? So I wanted to give you guys a couple of key pointers, a couple of heads ups as to what really underwriters are looking for. Maybe or maybe when you walk into a bank, how do I know if I'm even ready, right? So how do we know this? So first key component when it actually comes to preparing yourself, and one of the things that actually underwriters look for is, obviously, if you have a stable or steady job, that's gonna be one of the first key important things. And I'm gonna give you guys a rule of thumb. I know that some of you guys out there are from probably a different state. You might have different programs. So I'm gonna kind of, in a sense, generalize it to an extent, or prepare, I would say, for the worst, right? So now, one of the things that we should also consider when obviously having a job is making sure that you've had a steady job for a minimum of 2 years. That's super highly important for any underwriter. They want to make sure that you're obviously going to go ahead and pay whatever loan that you're obviously obtaining, right? One important thing too, even though you've had a job security for 2 years, make sure that there's no gaps in between. Obviously, if you've had a salary increase or maybe a position within the same company, that obviously doesn't apply because that's within the same realm of the 2 years. What I'm referring to is maybe going from one job and having some time or some time apart and then getting into a second type of job, even if they are giving you more or if they are compensating you for more. That's one of the things that they're actually looking for. So make sure, obviously considering that you do have 2 consecutive years, right? Another thing that you guys should actually go ahead and consider also, which is really, really important, is depending on the type of income that you receive, either you're a W-2 or you're a 1099 employee, right? When it comes to paying taxes, that's huge. Even for my 1099 employees. As a matter of fact, I was talking today, I was at the barber shop, right? And one of the gentlemen were asking me, Justo, how am I able to buy a home if, at the end of the year, I don't really declare it with a W-2? Well, you can actually buy. This is something that also has happened to myself. So I was a young homeowner many years ago. I'm in the process right now again. And obviously I am a business owner, so I am self-employed, right? So with that said, remember guys, it is important for you to file taxes and file if you are considering to purchase a home. First, you got to find out how much home are you eligible for, because that amount of money that you're actually declaring to Uncle Sam is going to be the determining factor as to how much home you could actually buy. So as a rule of thumb, take whatever it is that you declared at the end of the year, 50,000, or if you got a W-2 for 50,000, multiply that by 4, and that more or less could give you a rough estimate as to how much home you could actually go ahead and afford. So Filing taxes, extremely important. Don't obviously shy off from that. And again, if you are considering to making an investment such as buying your first home, because it is an investment, consider obviously filing for the max, depending on how much home you're looking to buy. Besides that, consider that there's things called debt to income ratios. Debt to income ratios, what that means is whatever it is that you earn versus how much you actually have in debt, right? So considering the fact that what you're gonna do is underwriters are gonna look into things within your credit report, right? So they're gonna look at all your credit cards, all the minimum payments, if you have a car loan. As a matter of fact, I'm gonna tell you this to you guys, because a lot of the times this happens, and I've heard this a lot, it used to happen to me a lot. People consider purchasing a car before their home. And if that's something that you're looking to do in the near future, keep in mind that if you buy a car right now, that could jack up your debt to income ratio. Why? Because you're gonna take whatever monthly payments you have on that vehicle plus all the minimum payments on your credit cards. If you have student loans, guess what? All of that's gonna take into consideration. Besides that, obviously the mortgage. You're gonna go ahead and divide that by how much you make. And if the percentage is over a certain amount, I would say a rule of thumb, keep it below 41%. You know, obviously depending on the lenders, they might even go a little bit higher. They could go up to 50%, 55%. There's different reasons as to why they do that. But to keep it safe, try to be below 41%. So if you are looking to purchase a home, maybe you have healthy credit, or you're in the process of rebuilding your credit, or you're through a credit repair company right now, and now you're getting to that, that anxious point of either do I buy a home, do I get a car, what do I do? Wait off on the car, because the car personally could either make or break the loan. So obviously depending on how much income you make. So that's something that's really, really important. So again, if you're obviously looking to also purchase a home, you obviously got to consider what's called the loan to value. And the loan to value basically means what type of down payment am I going to give? Because obviously you and I know money has to be in reserves. You're going to have to put some money away. The lender's going to want to see exactly where that money's coming from. So if you have a 401k, if that's where you're getting for the down payment or the closing cost, if you have a simple IRA, if you have a Roth IRA, or maybe you have a savings account, a mutual fund account, or a money market account, leave the money in there. And they actually get kind of flaky when that money starts moving around. So that's obviously a principle. Obviously know that there is going to be a down payment, and there's also going to be closing costs. I've heard so many times about people talking about first-time home buyers. There might be programs out there like that, maybe not having to come down with a big deposit or a big down payment, maybe 3.5%, or I've even heard of mortgage companies going as low as 1.5% down towards closing. So that's also obviously something to consider. And obviously credit. Credit's one of those key factors that could either make or break the loan. It could give you a lot of flexibility. And I'm actually gonna go into a few key points towards the end of this video. And now talking about for you business owners, right? You're obviously somebody who's you are in business, you're looking for a small business loan or a business line of credit. There's certain criteria that you should obviously take into consideration or no. Obviously when soliciting a business loan or a business line of credit. So obviously there's a traditional way of obtaining a business loan, right? Which could be through either a bank. And now there's different things. People ask me all the time, should I build business credit? Should I have personal credit? And I'm gonna be honest with you guys, they're both really important. And if it's up to me personally, from what I've experienced through my business, through my lines of credits, through my business credit cards, it's actually even more important to even have personal credit more than business credit, especially when you're dealing with a traditional lender such as a Chase or a Bank of America, or you're dealing with a Wells Fargo. For those type of companies, they're gonna wanna have what's called a personal guarantee. They're gonna want an individual to tag that deal or that debt to in case anything goes sour. So you obviously have to have a sufficient amount of credit, right? When it actually comes to business banking, or at least from what I used to do when I used to give out loans to the Bank of America, the key number factor there is a 680 credit score. If you don't have anything higher than a 680, then obviously wait up, because for the most part, all you're probably gonna do is run an inquiry and obviously get declined. Depending on how small the bank is, I do know there's other lenders such as like Bank United. We even have small banks here that also lend out Depending on the credit scores, they could go as low as a 650, 640. But a rule of thumb in general, again, like what I said earlier in the conversation, prepare for the worst. Try to have a minimum of a 680. And I'm referring to all 3 credit scores and 3 credit reports, right? They're all important. Besides that, also consider there's gonna be different ways on how to apply for something. Either I'm applying for a business line of credit, or am I applying for a business credit card? And there is a big difference. A lot of the times too, when we're talking about lines of credit, depending on the lender that you're going through, they might have different types of programs, such as either they're maybe gonna look at your financial statements. They're probably gonna look to see if you have a merchant account. They're gonna look at your receivables. They're gonna look at your stock. Depending on the type of industry that you're in, they're gonna probably want some sort of type of collateral. So obviously take that into consideration. So for the people who are actually starting for the first time, maybe your business line of credit might not be adequate because maybe you have not been in business for 2 years, which is another standard, right? So maybe leaning towards a business credit card could work. But again, take that into consideration. The credit scores have to be at a minimum of what? A 680 in order for most likely for you to be eligible for that. There is business credit cards out there. You can take out cash advances. Just note that the interest rates are pretty high or higher than normal. And there's also withdrawal fees as well. And for those people who are looking to refinance your property, again, certain criteria, as we spoke about early in the conversation with regards to purchasing a home, will apply. And if you're looking to buy a new car, also when it comes to that, credit scores are really important. The down payment, and also considering the loan amount, right? So now I really wanted to go ahead and tie all of this conversation that I'm referring to one thing, because I personally feel in honesty that having healthy credit is a determining factor when it actually comes to knowing the type of down payment, to knowing the closing cost, to seeing how high my debt to income ratio could be, to knowing all those key factors. Credit has a big influence. So if you're that person right now who's considering buying a home, considering a business line of credit, buying a new car, or maybe even switching jobs, how do I know if my credit scores are sufficient? How do I know if I'm in a good place in order for me to fulfill this, right? And again, what's the first thing that most lenders ask you when you're looking to buy? How's your credit, right? So even though that all those other things are really important, they can literally be influenced by your credit score. So if you're somebody who's actually learning for the first time, considering maybe even doing your own credit repair, or maybe working with a credit repair company, and you don't know if how long am I supposed to be there, am I even a good candidate to even get started on repairing my credit? Obviously I hear all the time that mortgage or lenders actually say, well, if you're actually repairing your credit and there's these little comments that come out on your credit report and they say, account under investigation, consumer disagrees, consumer disputes, then when it comes to that, then you cannot move forward on the loan if you have these comments. But I'm gonna show you guys a way on how to get those off as well. So how do you know if you're a good fit for credit repair, right? So one of the key factors is what I always like to work with is one particular thing, which is, what is your goal? Have you spoken to a mortgage broker? Have you spoken to the bank? Have you spoken to the dealership? Did they tell you the credit score necessary in order for you to fulfill that loan, right? And if you know what the credit scores are, well, that's exactly how you're gonna determine either you need it or you don't. So as an example, if you have a 650 credit score as the highest, or an all 3, but you're looking to consider obviously a business line of credit or a business credit card, you need a 680. So what are some key components? How could you know if you're gonna be a good fit either for a credit repair, or what could you do to obviously increase your credit scores? So a couple of things that you should actually go ahead and consider. First things are, am I eligible for credit repair? Well, you have to look into your credit report, right? And I've always spoken about, having your credit monitoring in place and go through it. And if you identify a negative item, an account that says potentially negative, an account that has a blemish, a late payment, maybe you have a charge off, maybe you have a collection, well, guess what? Those are key factors on knowing if, guess what? Could I work on this account? Could I challenge it? Could I dispute it and potentially remove it? Absolutely, right? So that's one of the key ways on how to identify a negative account and to know if there's any way possible within your credit report if you're eligible for obviously a credit score increase. And by disputing negative information, if you have those, then you know for sure you're a good fit for credit repair. Now, one important thing to consider though, and this goes back to the probabilities of success, because not only that you have a late payment, not only that you have a charge off, but keep in mind guys, in credit repair, depending on the length of time that has passed since the incident occurred determines the probability of success. So keep in mind that the longer the length of time that has passed that the collection entered the credit report, or maybe the charge off occurred 2 years ago, or maybe you know that the late payment that I have was from 3 years ago. And obviously, if you're considering disputing it on your own or consulting with another company, know that the probability of success is determined by how long the account has been on your credit. So the longer it has, the better. And it goes back to what the Fair Credit Reporting Act states, right? If anything is unverifiable, incomplete, or inaccurate, it must be deleted or it must be corrected. So that's a key component right there. Guys, so consider subscribing, liking, commenting. There's gonna be more fruitful information, financial information that I wanna go ahead and touch on. But until next time, thank you so much for watching. Stay tuned.